All right, for this next one, this guy was just plain mean. I don't know why he was so upset with me. Hey, I'm Kevin Pira, a certified financial planner, and today I'm reacting to your YouTube and TikTok comments. And basically the point of this video is to turn a negative thing into a positive thing. So I do unfortunately have a lot of negative comments because people that want to speak their opinions sometimes are a bit more on the negative side, and that's how YouTube comments are. So what I'm trying to do is to take a negative, turn it into a positive, and the format of this video is going to be sort of educational, sort of entertainment. So we're going to start with a few of the lighter hearted comments out there, a bit more on the education side. And then as the video progresses, things are going to get a bit more spicier and the comments might be a little bit more mean. But that's just how it is. I do, though, appreciate you guys' continued support so far on this channel. And let's go ahead and jump into some of these comments. All right, so here we go. We have 401k is not a tax deduction, it's a tax deferral. So in this video, I was talking about traditional 401ks and I got this comment. Unfortunately, this has 8 upvotes, which is sad to see because it's just not correct. So when you have a traditional 401k and you contribute to that traditional 401k, you are getting a tax deduction, you are reducing your taxable income. That's the main benefit of a traditional 401k, say over a Roth 401k. And this part that he's right about is that the taxes are deferred until retirement. So as that account grows over time in retirement, you're going to take that money out. And at that point, you're taxed at ordinary income rates in retirement. So he got it halfway right, but it's very important to understand you do get a tax deduction when you put that money into that 401k. That is the benefit of the traditional 401k. So in response to a video I did regarding a person with a ton of credit card debt, this user says, I agree, this debt is crazy, but who the F is getting an 8% return, LOL. So an 8% return is actually very reasonable in the stock market. And if you aren't invested in the stock market and you aren't really used to some of those higher returns compared to like a bank account or like a high yield savings, this is a very crucial moment for you and you really need to look into this and start researching this. So the 8% return, how I use it is say from the S&P 500, tracks the top 500 companies in the US by market capitalization. And basically, when we use the 8% figure, this is over a pretty long time horizon, and it already factors in inflation. So we have really 2 numbers we look at. So the geometric mean, that considers these up and downs of each year through the stock market. That is actually about 10% for the S&P 500. So after inflation, you could use, say, 7 to 8%, because inflation long-term runs around 3%. Now, you sometimes will hear this 12% figure out there. The 12% figure is the arithmetic mean of the S&P 500. So technically you could use that, but again, that doesn't factor in inflation. And that average really isn't truly accurate into how we would calculate the true mean. So stick with the geometric mean, and to make it even more accurate, use the inflation adjusted mean. Comes out about 7 to 8%. So if you don't already, get involved in the stock market because building wealth, you're not going to obviously get that from a bank account. You need to be exposed to some equities out there as well. VZ Rover says, I grade this vlog and D-. I do like the bull bear sculpture in the background though. Thanks. Well, thank you, sir. I really do appreciate this comment. I do like this sculpture as well. I got it actually off Amazon. I think it was like 80 bucks like a few years ago. I thought it really looked really cool and it was less tacky than some of the stuff I've seen out there regarding like stock market merchandise. So again, I think it's a nice piece too for the set. So it works pretty well. The funny thing about this comment is, and I can't prove this, but this guy actually gave me an F at first, and then he upgraded me to a D-. So my response to you, VZ Rover, is, what did I do to earn a F upgrade to a D-? Let me know in the comments. In response to a video I did about gold versus the S&P 500, Kenneth Williams says, apples and oranges. One should own both in a well-balanced portfolio. Look at what gold has done in the past 2 years. I know that's cherry picking, but the point is, over some periods of reasonable time, gold has done better than the S&P 500. In fact, the younger an investor is, the more gold and speculative investments he can safely bear. Also, more focus on dividend-paying stocks is advisable. People say gold isn't a good investment because it's a dead investment, but any non-dividend paying stock is exactly the same thing. The only profit potential is if the asset itself rises in value. However, dividend-paying stocks offer their additional benefit. So strongly disagree here on this one. When we compare the S&P 500 to gold, I mean, gold has just vastly underperformed the S&P 500. It's really not even a question of debate. Any research can just easily show you that. Can somebody who's younger have more gold than speculative investments? I would say yes for speculative investments. You have a much longer time horizon and you can earn more income over your lifetime likely. So yeah, you can take more risk when you're generally younger, but that doesn't mean you need to go crazy or invest in gold necessarily. And then also, the dividend side of things. I can tell you right now, there are many very good companies and very big companies that do not pay a dividend. Here are just a few on the screen right now. I'm sure you've heard a few of these, and I can tell you right now, those stocks are not appreciating just because someone else thinks that the price is going to go higher. Sure, you could say that's part of it, but these companies actually do produce a profit, some of them, and when they produce a profit, that increases shareholder value and the whole spiel from there. So again, there's actually services and products being delivered from those companies, whereas gold, and again, I don't hate gold. I think it's fun to collect. I like collecting it. I think it's fun. But the problem with gold is it really kind of is what the next person's going to pay you for it. It doesn't produce anything. So you could say it's a store of value, it's an inflation hedge, and I'll hear arguments on that. But when it compares to the S&P 500, it's really not a good investment at all. If you are going to invest in gold, personally, I wouldn't do more than like 1 to 5% of your portfolio in my experience. And yes, just because it's done well in the last year or two does not mean it's going to keep doing that. But again, if you like gold, do what you want. It's your life, it's your money, do what you need to do. But for me, I just don't see it as a good long-term investment, and the data does show that as well. In response to a video I did about paying down high interest debt and not paying down low interest debt in certain circumstances, Isaac Smith says, a real man pays his debts. So again, I really don't agree with this. I think this is actually kind of like a Dave Ramsey take, where if you have low interest debt that you should pay it down. If you have a mortgage that's under 3%, 4%, 5%, I'm not going to pay that down. I mean, it just doesn't make any mathematical sense to do that. And for what? You're just going to be foregoing a ton of investment gains in, like, say, the stock market, where the opportunity cost to pay down a house. I mean, sure, there's a very small, feasible benefit and risk reduction for doing that, but the amount of money you're foregoing in the stock market over that period of time is pretty strong in my opinion. But again, if you are somebody who wants to pay down your house, that's up to you. Personal finance is personal. Don't let anybody tell you what you should and shouldn't do in your personal circumstances. But again, when we have comments like this, a real man pays his debts, I think it's a little silly and is definitely glossing over the point I was trying to make about the opportunity cost. In response to a video, I talked about the power of compound interest. Ye says, wow, 2 million at 65. So I get 2 million and then I die at 70. That sounds so fun. Okay, so this one made me laugh a lot because there is this problem where people online seem to think that you shouldn't invest because it's a long time horizon sometimes. And that long time horizon is just, you're just foregoing everything by investing over that time horizon. It's just everything else is put on halt. Everything else is horrible because you're putting money away and saving for yourself in the future. I mean, it's complete nonsense, guys. Having a few $1 million, couple $1 million, whatever you have in retirement, more or less, that's a good thing. And comments like these really actually do worry me to some sense because people like this who think that this, unfortunately, are going to end up living on Social Security, and I've seen that many times. And I come from a family, trust me, we're not very well off at all. And, when you have people who don't save for retirement, it comes down to things like Social Security and other things like that. So there's nothing wrong with, divesting part of today for a brighter tomorrow. Don't let comments like this, try to distract you. Having money in retirement is a very good thing. In response to my recent video where I tier listed different finance YouTubers, I gave Dave Ramsey an A, which again was pretty generous, I must admit. But Bob Smith Home 2 says, you totally lost me with Dave Ramsey. That guy is a hack who doesn't understand investing. He should be on the F tier. This guy is the guy who tells retirees they can spend 8% of their assets each year. Absolutely clueless hack. This also tells me you have no idea what you're doing. I think I did state this in the video. I did say that the investing side of things, he is really far off. I mean, yeah, when it comes to the safe withdrawal rate of 8%, that's absolutely ludicrous. And again, Dave Ramsey, I probably was a bit generous to him. Maybe I would bump him down to a C or a B. But again, I was trying to take the approach where, like, hey, he got the conversation started for a lot of people when it comes to personal finance. And I think he has helped a lot of people get out of debt. We have to understand a lot of people are in debt, and a lot of debt, credit card debt, high interest debt. So him telling people to aggressively attack that. I thought that was a generally good thing, so that's why I came to that approach. But I think it's totally reasonable and understandable that people would put him at like a D or an F tier just for the fact that his investing advice is very, very bad. Again, I'm not trying to cozy up with Dave Ramsey. You know, he calls CFPs certified financial Pharisees, so it's not like somebody that I think has thrown me any good comments my way at all. So again, I understand where this person's coming from. It's a bit, harsh, I think. I think YouTube comments sometimes bring out the worst in some people. But hey, we can agree to disagree on some things, and that's the point of YouTube comments, is to see what other people think. In that same video, Jonathan Harris 4111 says, when you said Ben Felix is a top guy you listen to, that tells me all I need to know that you are clueless. So pretty harsh there, Jonathan. I'm not sure exactly how you came across with this comment and how you came to this opinion. At the end of the day, I just like people who are academically backed, they have the right credentials, they're showing genuine research papers that have real data and real data scientists showing how they reach their conclusions and the data they've shown, and then Ben Felix kind of interpreting that with his credentials. Again, does that make Ben Felix this all-knowing God when it comes to investing? Of course not. And I do think there are some flaws maybe in the very, very serious academic approach that he shows, and then the real world as well. But again, Ben Felix, he takes a very good approach, and I'm gonna go ahead and just side with Ben Felix over some random guy on YouTube comments with an opinion who doesn't really provide any substantial argument with his comment. In response to a video I did regarding VTI as a total US stock market index fund, Zeleno Japko says VTI is not total market, VT is. Are you sure you're qualified to judge other people's financial content? VTI is not the optimal investment advice for most people. VT is. I think you should listen to Ben Felix more. This one cracked me up quite a lot because it's just wrong. VTI is very much so the total stock market index fund here in the US. He may be just misunderstanding what I was saying. VT tracks, much more world investable assets versus just the US. There's a ton more stuff in there. It technically tries to track the whole world. But again, when it comes to this type of comments, it's just completely unfounded in reality because he just must not have watched the video. And in fact, I had a couple other people on here commenting saying like, dude, what are you talking about? He said this in the video. So again, just comes out the gate swinging, and it's definitely a miss. But let's go ahead and jump into the next one. In response to a video I did on TikTok about Trump's 50-year mortgage plan, Kevin says, wouldn't this assume the interest rate would go down with a 50-year rate? LOL, your video is so bad. So no, this is just not correct. If you have a 50-year mortgage, the interest rate is almost certainly going to be higher than like a 30-year or obviously a 15-year because the bank is taking on more risk with a longer time horizon and for other reasons as well. So when we look at a 50-year rate, I would anticipate that to be higher than a 30-year and obviously a 15-year. And so what I was trying to say in that video was that a 50-year mortgage is just a bad idea because you're just putting a Band-Aid on the affordability crisis in the US. And in some ways, you're actually making it worse because you're basically taking people who don't fully understand amortization schedules with mortgages and are just stretching out the term another 20 years. What's going on is you're paying about double the amount in interest to the bank for like a 15 to 20% reduction in your monthly payment. It's a very, very bad deal. So again, I didn't like the 50-year mortgage plan, and unfortunately, Kevin here, just go do more research about it because I think you're going to come to your senses and see that it is a pretty bad idea. And I'm hoping that the government just scraps that one and tries something else. Guys, as we wrap up this video, I just want to say thank you. So many of you left so many good thought-provoking comments with a ton of positivity too. And I don't want this video to overshadow any of those comments at all because the point of this video is to turn something negative into something positive. I probably will do another video, just a general response to some of those other comments out there. But again, thank you very much for the positive comments. And most people, let's be honest, the silent majority, just gonna leave a like or watch the video and go about their day. They don't even leave a comment. So people that are leaving those nice extra positive comments, I genuinely do appreciate it. I am new to this stuff when it comes to YouTube. I'm only a month in. I don't know a whole lot about how to, my studio and how to make videos really that great yet. So I'm trying to improve on that. And I'm hoping that I can learn from other people out there, and hopefully I can educate some people on the personal finance side of things as well. So that's all I have on my end today, guys. Thank you again so much for watching, and I will catch you in the next video.